I'm Charlotte McLeod with the Investing News Network, and here today with me is Will Rhind, CEO of GraniteShares. Thank you so much for joining me online once again. Great to see you.
Likewise, great to see you. Thanks for having me back.
Yeah, and we haven't talked for a couple of months. Of course, there are a lot of things to go over. And where I thought we could start is with the Federal Reserve's latest meeting, which happened last week. We got a rate hike of 75 basis points. Since then, we've had Chair Jerome Powell out telling everybody how hard they're going to be fighting inflation. I wondered if you could give me a sense of the Fed's path forward in 2022. What does it look like for you?
Well, I think that market expectations and indeed what they will most likely deliver will most likely be a couple of extra rate rises between here and year end. And of course, on the one hand, they're trying to telegraph what those rate hikes are going to be, but on the other hand, I think they want to maintain flexibility, or they're giving themselves some room to retain flexibility, given that inflation at the moment keeps creeping higher month on month. So I think we definitely expect some more rate rises. As to whether it's going to be, on the higher end or the median or lower end, we'll have to wait and see.
Certainly, we will have to wait and see. And, you mentioned that flexibility that it seems like the Fed may want to have. I was reading, I think, in the Financial Times this morning, an article where Powell was talking about the fight against inflation and the work that they're going to be doing to make that happen, but also mentioning there could be surprises when it comes to inflation. So what do you think he could mean by that?
Well, it's obviously difficult to interpret what exactly may be meant. I think, that it's worth mentioning perhaps that there's different types of inflation. So I think we like to talk about it as one sort of simple construct, but there's inflation that perhaps the Fed is more in control of, and there's inflation that the Fed is much less in control of. So cyclical inflation, there are things like commodity prices, for example, they're much less able to have any influence on commodity prices as much as they are with, say, credit, whereby by tightening interest rates, you're effectively reducing, the buying power, if you like, in the economy. So they're much more able to influence certain parts of the inflation that we have than others. And so maybe that's kind of what he's alluding to.
I think that's a great point, because it seems like we're all looking to the Fed as the one entity that's going to save us from inflation. But as you mentioned, of course, that's not true. Is there work being done in other areas to curb what's going on?
It is interesting because, again, it's just a funny construct, I guess, of the environment that we live in today, and sort of how we've got ourselves into this position, whereby, like you said, we are relying on the central bank, as sort of the market at large, if you will, to perform this task of either controlling inflation or, obviously, in years by, it was trying to induce inflation into the economy. And I think in some respects, it's kind of an unreasonable ask of the Fed to do that, given that, again, there's some things that maybe they can or they do have more control over than others. But certainly they were really unable to engineer any kind of inflation in the economy when they needed it or when they wanted it. But obviously now that we do have inflation at the moment, at least, and again, one could argue that we're only just starting, but with 6 months gone roughly of interest rate tightening, we certainly haven't been able to influence the inflation numbers at all at this stage.
Right. And so as we have all of this going on, working to fight inflation, a lot of market watchers seem to be believing that we're now heading toward a recession. On the flip side of that, we have people like Joe Biden, Janet Yellen telling us that that's not necessarily going to happen. We don't have to go down that path. What's your view on whether we're headed toward a recession at this point?
Well, I think that it's, again, the probability, and I think this is where a lot of people look at, is I think in history, we've never had an environment where inflation has been above, I think, 4.5%. And it's been able to be brought down below that number without causing recession. So certainly the probability leans much more towards there being a recession. And I think it goes back to this idea that there are some things that the Fed is more able to control, others less. And I think that provided we still have inflation at these numbers, at some point it starts to sow demand destruction. And so the consumer starts to change their habits. And of course, given the American economy is 70%, or the GDP is 70% reliant on consumer spending, that really is kind of where the rubber meets the road. And from a demand perspective, ultimately, if consumers stop spending money or spend less, that's where that demand is going to be felt, and ultimately, that very well could be recessionary. I think the idea that we can, engineer a situation, or the Federal Reserve can engineer a situation where inflation falls, and we just kind of go on happily ever after, seems a little bit less likely at this stage.
Yeah, definitely the happily ever after scenario is not looking very likely at this moment. I wondered if we could talk about gold, which may be a little bit of a more positive side. I think that one of the most common things I'm hearing about gold recently is that the price is doing well given what's going on. It's holding up well compared to other assets. It's preserving wealth. Would that be your view on gold at the moment, or would you say it should be doing better given all the things that are going on?
No, I think I'd largely agree with that. I think that really the issue, if you want to look at it like that, but certainly what has kept gold prices in check has been the strong dollar. And clearly we've had an environment which, all things being equal, should be terrible for gold. In other words, we have tightening or interest rate rises, real interest rate rising, and that resulting in a very strong dollar. It's not necessarily a good environment for gold. What makes it so resilient, the reason why gold prices are still this high, kind of on a historical basis, is because of the inflationary backdrop, the geopolitical backdrop, and the fear that this is all going to end up something like the 70s. In other words, there's going to be a policy mistake from central bank or central banks, plural, that will really allow inflation to either get out of control, markets to get out of control, and ultimately the dollar to fall, and people will need a safe haven alternative to the dollar, to traditional stocks and bonds, and gold clearly is one of the, if not the best alternative out there.
Right. And, just because you mentioned it, this comparison to the 70s, that's another one that seems to be cropping up quite a bit. In your view, does that comparison make sense? Or are we in, kind of a unique circumstance, or is there a different time period that you would think makes a better comparison?
I think the 70s at the moment, there are a lot of parallels to that because we have the commodity price shock, which we have in the 70s. Plus we have the high inflation. Again, that's really the only period of high inflation, consistently high inflation that we've had, which was the 70s. So you have to really look back on that period for much of a comparison. Like everything, that there will be, there's situation or things about today that are different. But I think what isn't different is in a period of high inflation, real assets are, where people want to be. And clearly, consistently with that theme, commodities have been the best performing asset class year to date, along with real estate and other hard assets.
Okay. And, you started to mention the geopolitical side. I think the last time that we spoke was right when the Russia-Ukraine war was just beginning. And we talked about the fear factor being back in the market for gold. Now it seems like the conflict is still going on, of course, but it's really faded from the headlines. Is this something now that's been priced in for gold?
I mean, gold, I think you can make an argument that for a number of commodities, the war in Ukraine is largely gone from the price premium. Certainly, I'd say that's the case for gold. To a lesser degree, oil as well, but certainly commodities like palladium, which was almost exclusively a Russia story, the price of palladium is back down to where it was, way before the wars, or where it was beginning of the year, actually. So really, any premium in that has come out of the price. So I think we're sort of leaning towards perhaps a picture where, if the war kind of stays isolated to the eastern part of Ukraine, particularly in the Donbass area, and sort of becomes less of a front page news, if you will. And that I think is what you're seeing largely in the price of some of these commodities. The focus, I would say, is much more about where we are vis-a-vis the central banks, inflation, and interest rates.
Yeah, certainly, I think that's definitely correct. And when we were talking last time about what's going on in Russia, we spoke about palladium as well. We spoke about platinum, I think, a little bit. I want to get your sense on the precious metals complex as a whole right now. Where are you seeing the most opportunity right now as we're about halfway through 2022?
I mean, I think the story across the board is, as I was just mentioning, that precious metals have held up well. Now, obviously, there's been a peak, which was a lot to do with, or maybe exclusively to some degree, with the war in Ukraine. But like I said, that premium is gone. But the metals, broadly speaking, aren't down year to date. Certainly nothing like what's happened in the stock market. So from that perspective, platinum, palladium, silver, and gold have held up well year to date. I think really the question is now, what happens going forward? And an interesting thing vis-a-vis gold is that, as we've seen really just starting to develop in the last couple of weeks, that what happens when you raise interest rates is you're tightening financial conditions. And things will start to appear, and they are starting to appear, that we haven't worried about for a long time. So, for example, sovereign debt in Europe, that you've seen spreads be historically extremely low, and that now starting to become more of an issue, certainly as we saw with the spread in Italian government bonds, for example, widening the most in many, many years, and sort of harking back to the era where we had the Greek debt crisis and some of the other peripheral European countries. So when you tighten financial conditions, the natural result of that is that weaker credits start to get exposed. And if that starts to show up in sovereigns, that will certainly, and has been showing up in corporates as well. And so I think that's where things start to get a bit more interesting, and we'll see more central bank intervention in that place, in places needed. But for me, again, gold seems to be in good position right now, that it's really managed to shrug off a lot of the negatives around rising rates and a strong dollar. And I think people have got to ask themselves, how much more can the dollar strengthen from here? Sold off was a little bit the last few days, but realistically, is there more upside for the dollar here, or is there more upside for gold? I think, clearly I'm in the camp of favoring gold in that one.
Right, of course. And amid all these circumstances, there's a lot of volatility, there's a lot of uncertainty. I think that people are looking for more towards things that are real. So we have the precious metals that fall into that category, of course. Are there any other assets that you would place within that sector?
Yeah, I mean, real estate clearly is an obvious one that's been doing really well year to date. And again, that is part of the hard asset complex. People looking to own, physical things, real things. Historically, at least, have done well in times of inflation. However, again, I think that the trouble with some of these asset classes, and we'll start to see it now with real estate, is particularly on the mortgage end, that with rates springing up the way they have in the 30-year here now well over 6%, that's a substantial increase from where it was 6 months ago. And so, the 30-year mortgage, for example, has gone up, I think, over 40% at this stage in 6 months. And that makes a material difference, obviously, to anybody that's holding a mortgage on property and real estate. And again, that's just another way of saying that financial conditions are tightening. People are spending more on mortgages. They have less room to refinance in terms of taking money out of their homes to spend. And all that means that the ability of the consumer to spend is more curtailed now than it was 6 months ago. So I think that will impact real estate prices, and certainly we started to see that show up in the data in terms of sales starting to slow from the record pace that we saw, earlier on in the year, and indeed clearly last year.
Okay, you've given us definitely a lot to think about. And as we wrap up, I wondered if you could put kind of what we've been speaking about in the context of the broader commodity space. We've talked in the past about the commodity super cycle idea. What are your thoughts on that at this moment in time?
Well, I think very simply that in inflationary times such as this, commodities have proven to be really one of the go-to places to hedge those risks in portfolio. And frankly speaking, if you haven't had commodities in the portfolio this year, you've almost certainly lost money. And I think that for as long as we have elevated inflation, people need to have a hedge in the portfolio. I'm not saying that that's exclusively commodities and it can only be commodities, but I think people really need to have something in the portfolio to help protect against this inflationary problem that we're having. It's clearly affecting the stock market, it's affecting the bond market in a way that we haven't seen in a long time. And so having some way to hedge against that risk, I think, is prudent. Broad commodity, whether people choose to express that through a broad commodity ETF, such as our COMB, or a physical gold as our bar, or any other way, be it precious metals or broad commodities, obviously that's up to people's own choice. But I think that's really the kind of the key takeaway, that providing we have this elevated inflation, and remember that the 70s, we talked about a decade of inflation. This went on for a long, long time. This wasn't 6 months. And I think there are some people starting to question whether we've seen peak inflation, after only 6 months. And even if that's the case, I think that peak inflation doesn't mean that inflation is going to quickly retreat back down to sub 2%. It simply, in my mind, just means that we're going to have parts of the economy that may experience elevated inflation for years. It might not be 9% or plus 10%, but you can certainly see elevated inflation for quite some time. And I think from that perspective, some of these supply chain issues that we've seen aren't going to solve themselves quickly, and therefore buying commodities or holding some inflation protection, I think, is prudent.
Okay, that's definitely a little bit of a sobering note to end on, that 6 months of inflation versus an entire decade that we've seen previously. But it sounds like people have choices within the commodities sector that they can use to hedge against that. So thank you so much for coming online to share about what's going on in the resource space right now.
Yeah, thank you so much for having me again. Pleasure as always.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Will Rhind of GraniteShares.